Let's get started. I know people are still joining, but given it's recording and recorded, some of this can be caught later. So welcome everyone. Thank you for joining today's webinar. My name is Stu Willson. I'm the CEO of Radicle. A little bit of context on who we are. Radicle helps the world's leading companies, customers like Silicon Valley Bank, City Ventures, Fidelity, AmFam Venture Build, and Me Re make faster and better informed investments in the future by identifying and uncovering the latent expertise, domain experience, and insights of startup founders, leaders, and investors. My director of research has been publishing a lot on the future of insurance. If you're interested, check out some of his great perspectives, including a recent interview with Matthew Jones of Anthemis on our website. And there's a bunch of other content there as well. So today we're excited to partner with 3 Insurtech market participants whose unique perspectives will help us better understand what the future of Insurtech will look like. Where is the greatest innovation happening? What areas are strategics most interested in? Where will the M&A interest be greatest? What is valued most? Capabilities, customers, distribution channels, or something else? We're excited to have Greg Smith of Financial Technology Partners, Dan Reed of American Family Ventures, and Eugenio Gonzalez of Plug and Play Insurtech. Rather than provide my version of who they are, I'll let them tell you themselves. But just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your Zoom. I'll bring them up during the presentation. We'll also have some time for questions at the end. And also a recording of this webinar and the presentation will be available to all registrants. Look into your inbox later this week for that. And without further ado, let's get started. So before we start, I think it'd be helpful for everybody to understand who you all are. Maybe we could start with Greg and then go to Dan and then Eugenio.
Sure, thanks, Stu. Hey everyone, I'm Greg Smith with FT Partners. Been with FT Partners for about 7 years. For those of you that don't know us, we're a boutique investment bank focused exclusively on fintech. So really 99% of what we do is capital raising or helping fintech companies sell. We're almost always on the sell side, working with the entrepreneurs or the companies looking to transact. And we're about 170 people now, have clients on all 6 continents where there are fintech companies. And we do quite a bit in Insurtech. Really, in Insurtech, just in the past, I'd say 4 or 5 years has really come on the scene and become a big important part of our business. We kind of saw this wave coming and published a bunch of content on the space, and now it's a very important vertical for us. And just quickly on my background, I've been in fintech for a couple decades. Spent my whole prior career as an equity research analyst. Started covering fintech in the 90s and was at a bunch of different firms: Hamburg & Quist, JP Morgan, Merrill Lynch, a few others. So I'm kind of one of the gray-haired veterans in the fintech space, and excited to be here talking about Insurtech.
Awesome. Dan?
Thanks, Stu, and thanks for having me, and thanks everyone for showing up. I'm Dan Reed, Managing Director of American Family Ventures. We started American Family Ventures back in 2012. The idea was to get more involved in some of the technology advancements that were going to shape the future of the insurance industry. We structured as a corporate VC and secured a balance sheet allocation from American Family Insurance to focus on early stage investments in and around the insurance market. As our practice matured and the portfolio developed and the Insurtech space really started to heat up, we decided to expand the capital base, and we raised money from 13 other insurance industry participants for what we call our Fund 3, which is a couple $100 million fund. Again, still focused in and around the insurance industry at the early stage.
Great. Eugenio?
Sure. Hi, everyone. My name is Eugenio. I'm a principal with Plug and Play Ventures. For those of you that don't know Plug and Play, we're the largest innovation platform in the world. You have over 400 corporate partners which provide us with an ecosystem of access to some of the largest companies in the world. And what we do basically is we bring together the entrepreneurs with the decision makers at these companies to make innovation happen, helping out entrepreneurs with short sales cycles, access to someone that has a P&L within those companies, and eventually help those companies as well to get to where they want to be. I sit within the investment side of things with the ventures team, where I oversee teams within 4 or 5 different countries. We're basically doing somewhere around 40 to 50 investments each year. And some of the core investments within our team are Insurtech investments.
Great. That's helpful context for everybody. So maybe we could start with the state of the market. And I thought, Greg, given your position within FT Partners and FT Partners' position within the market as a advisor to companies making acquisitions, companies selling themselves, companies raising capital, companies IPOing, and perhaps other strategic initiatives I haven't mentioned. I thought you'd be well positioned to talk about what does the Insurtech market look like in 2020? It's obviously not a normal year for many different reasons. What role has that played with respect to Insurtech?
Yeah, I'd say to sum it up in one word, it's been vibrant, extremely vibrant. We've actually seen very little impact from COVID. I mean, the only place we saw any impact was on the M&A side in the second quarter. It got a little quiet. There were about 11 Insurtech M&A transactions in 2Q, but that bounced right back in 3Q. And actually, if you look from a financing perspective, it's really sailed right through COVID. 3Q was actually the strongest quarter ever from a dollar volume perspective for private Insurtech company financing. We track all these stats. We just published our big 3Q report. So it's all proprietary stats, but pretty shocking how strong things were in 3Q. And it wasn't not only on the private financing side, we also had 5 IPOs, which is really unheard of in the Insurtech sector. We've had a couple IPOs earlier this year, but that was pretty shocking. And when you step back and think about insurance, you got to remember this is a big space, and there's lots of different people viewing it from both from the investing perspective and the M&A perspective. On the investing side, you've got traditional VCs that are interested in the space. You've got private equity. We've seen some significant PE buyouts this year. You've got strategic investors like Dan looking at the space. And actually Insurtech, when you compare it to all other areas of fintech, it has the most participation from strategic investors. Literally 49% of every Insurtech financing in 3Q had a strategitic investor. So there's really this tight knit between the companies and strategic investors as well. And also when you look at insurance, it's broad from a lines perspective: P&C, life, health, specialty, personal, commercial. And then you've got the whole software and data side as well, the arms dealers to the space. And so we're literally seeing activity and working on things across all these areas. So I think it's even sort of a bigger space than people realize. And I guess one other thing I'd say is just from a trend perspective, like everywhere else in fintech, we're just seeing a dramatic acceleration in the digitization of the industry. And obviously COVID, I think, has really accelerated that. So in an ironic way, COVID has been a catalyst to just dramatically accelerate the need for tools and the need for carriers and traditional players to really digitize their businesses. And that's part of what we're seeing going on from an investment and to some sense from a M&A perspective as well.
Awesome. And Dan, you focus primarily on the earlier stages. Can you talk a little bit about how that market feels currently?
Sure, yeah.
And what, if any, impact COVID has had on Insurtech companies seeking to raise capital at the early stage?
Well, a lot of the points I would make are pretty similar to Greg's perspective. and he's got a broader set of data, and he's got a cooler Zoom background, so it's hard for me to keep up. But I guess my personal experience was, I think probably like a lot of the people who were on the call here, in March and April, things were really tense and sort of intense, and everything was on pause. You know, we were meeting as a team on a probably every other day basis, trying to assess what the impact of COVID and the economic crisis would have on our portfolio. And I think importantly to us at the time, we were not yet closed on our new fund. And so we had a number of LP conversations just essentially freeze really through April. We were, I thought we were quick in turning the corner and thinking about, you know, this is an opportunity for us to be out in the market and pursuing deals. But in hindsight, I think we were having the same thoughts that really everyone was having, which is, you know, once we reached some stability with regard to the virtual operations, you know, both within the venture team, but then also across the companies that we support. But I think the whole world turned toward what is the opportunity in this crisis. And you know, by May, the capital conversations were opening back up and in full swing. We were getting lots of surveys around the venture market about, you know, are you still doing deals? Would you ever do a deal without having visited the you know, the company's site in person? And we were looking at each other like, yeah, of course we're doing deals, and of course this is what we have to do now that we're you know, the M&A side of it has never been busier. You know, the opportunities to invest have never been busier for us. And now here we sit in November, we're still tracking the COVID situation. In fact, it's hotter than it's ever been from a caseload point of view. But the conversations we're having among the team are we deploying capital too quickly into this market, and what's this going to do for the you know, for the investment period of our fund? So it's but you know, all that said, that's pretty much in line with what Greg said. It's been a very busy, a very active, and you know, sort of shockingly unusual time that we've all been living through here.
Yeah. If you had to describe a few reasons for that, there's the digitization of everything that I think COVID has catalyzed. There was the Lemonade IPO earlier this year. How do you think about what's causing people to get so excited about Insurtech today?
You know, I do ascribe it to that call to transformation. It seemed like, you know, for a couple of our major LPs, the timeline toward transformation just accelerated overnight. It's almost like a switch was flipped, and we moved from thinking about American Family's footprint. It was something like, you know, 30%, 35% of the employee base was remote. It moved to 99% essentially overnight, and that sparked a conversation about, wow, if we could do that, you know, what else should we be doing on a faster pace? And by the way, we have this huge backlog of Insurtech oriented transformational opportunities. Let's you know, let's put some more weight behind them. Let's put some more urgency behind them. And that's been a consistent theme across all of the LPs that support us. Is, and the time is now, and we're much more capable of transformation than we thought. So let's really get to it.
Right.
You know, I'll just add in, you know, we're starting to see new things working. You're seeing we're seeing policies bind online. We're seeing new data being used. And so sort of all this innovation and investment over the past couple of years, you're starting to see that take effect on the industry and seeing the success of some of the recent IPOs. So there's kind of proof points out there that I think are helpful for investors that we're seeing traction in different areas. And then you layer on top just that dramatic need to transform and digitize everywhere. You've got, you know, some interesting milestones with companies going public. And so you sort of put it all together, and it sure looks like a great space to be innovating in, investing in. You know, we haven't seen a lot of M&A exits, but starting to see some exits, and it's all kind of coming together in a great kind of all the ingredients of an ecosystem you need for there to be continued investment all the way through and to exits. We're seeing that happen in this space.
Got it. And Eugenio, you sit at an interesting position between many insurance partners of Plug and Play, as well as the early stage companies that you invest in. What are you hearing from both sides? And, are they aligned in terms of why they are excited? Why are, big companies excited about continuing to invest in, insurance startups? And why are entrepreneurs, continuing to launch new Insurtech business at this time, given what's going on with the environment?
Yeah, it's a great question. I think Greg and Dan basically touched upon this and how we've seen a massive shift from what was Q1 and Q2, where things are now in Q4 looking very differently. Everyone sort of embraced this work from home. We've heard from a number of companies that they had even issues at accessing their fax machines. I mean, people working from home couldn't even go and either retrieve whatever was being sent over to their offices. And now that everyone has gone digital, we're mainly seeing that companies are able to, or have no fear in actually going the route of becoming a current or present company. We're talking about insurance companies which are very risk averse. Just because they deal with risk on a daily basis doesn't make them the most prone to actually engage with startups to be at the forefront of what's happening. And with the public markets basically picking up and behaving like there's no recession, we're seeing that capital flows from LPs to GPs to now founders. People stop talking about winding down and shutting down, and now are keep building, keep engaging, which makes it very different from what we saw at the beginning of the year, which was a pretty grim, to now seeing how companies are basically trying to engage much more so from a number of different areas. And I think to what Dan pointed out is we're also starting to see some new challenges within insurance companies that before they hadn't even realized, like work from home and how to build a culture within a company. Some challenges that they were not really taking or hadn't really thought about, which are potentially driving new and exciting opportunities for entrepreneurs to build on.
Awesome. Maybe we can take a step back. And I'd love your perspectives on this question. What is Insurtech? And I ask because one can draw a circle around insurance as wide as they like. And there are a lot of things: drones, home warranties, smart devices. When you think about Insurtech, what do you think of as being in scope? And what do you think of as being out of scope? What is Insurtech today?
I'll take that one. I mean, we literally, every single company that comes in, we make a determination. Is it fintech? Is it not? And same with Insurtech. If it's fintech, is it Insurtech? Is it not? So we actually have formal definitions for all these things. So I kind of deal with this on a daily basis. I mean, so for us, Insurtech, it's both new insurance ventures, so actual MGAs, brokers, carriers, as well as the whole technology side. I think the technology side, where it becomes more of a gray area, is are they primarily serving insurance, or is that just one small aspect of the business? So some sort of IoT company who's 100% focused on flood sensors or something like that, or really focused on distributing through insurance carriers, we do consider that Insurtech. So it does broaden out. Now, a drone company that's doing surveillance work for some insurance companies, but does a whole bunch of other things, we wouldn't necessarily put in the Insurtech bucket. Even in our database, we even have what we call sort of partial fintech, a company that some minority of their business is fintech or Insurtech related. So we even have that definition. But I do think that the purview goes outside of what you would traditionally think, and it does get into IoT and other areas. And frankly, those are some of the most exciting areas of Insurtech, the way the industry is leveraging all these technologies to better underwrite and gather additional data. So from our perspective, the FT Partners perspective, that's all in scope. I mean, telematics, you could throw that in there. Those devices, that's all in scope of Insurtech for us.
Got it. And Dan, how do you think about where you draw the line? There are investments that you've made that some may not see the line to insurance, and there's some that are pretty clearly insurance underwriters. So how do you think about the circle of definition around Insurtech?
Yeah, I mean, it certainly evolved over the years. I mean, when we got started back in 2012, there wasn't an Insurtech term. So really it was just what are the areas that we think are relevant to an insurance carrier or relevant to the future of the insurance industry? And we cast a pretty wide net around that. We defined that a bit more narrowly over the years. And so every deal that we do has some nexus back to the insurance industry or our vision of the insurance industry of the future. It's the commitment that we've always made to our capital sources, is that we're going to make deals that are relevant. It used to be because there was kind of a dual mandate, as is often the case for a corporate investor, is you're seeking financial returns, but you're also seeking some sort of strategic optionality. In the past maybe 5 years, we've really changed our perspective on that, and now in order to get advantage returns, you have to have some sort of advantage perspective on a market. You have to be a smart investor. And so for us, it's been less about capturing any sort of strategic value and more about what are the areas that we as investors and the people who support us have some advantage in assessing or adding value to for us. But I mean, more specifically to your question, the way that we think about what's in scope for us is, number one, it has to have some nexus back to the insurance market, but quite specifically how we think about it is sort of typical concentric circles where this definition of Insurtech is in the center of it for us. And those, what constitutes sort of pure Insurtech for us are companies that are directly competing with carriers of today. So you think about all the Insurtech carriers, a couple of them went public recently, but we have a handful in our portfolio as well. And then the other kind of pure Insurtech definition for us is typically software companies that serve the insurance market as their primary vertical. That to us is Insurtech. Those are the deals that we feel comfortable leading, competing to be the lead investor, and that's kind of the center of the hotspot for us. From there, the ring outside of that is what we call our adjacent ring. So those are companies like AI companies or others that serve the insurance market, but maybe not as the only or primary market. You can think of a company like Hover out of San Francisco, which is one of our investments that does that. They work with the insurance market, but they also work the home contractor market and others. The other component of that adjacent space for us are companies that would be great partners for insurance distribution or data. We thought about Ring, doorbells as a component of that there's a natural synergy between people who are investing in security of their homes and possibly advantaged homeowners risk for a distribution model. And then the third ring for us is what we call our enabling category. So these are things that are changing the nature of risk in a broad way. So we think about IoT businesses or future mobility businesses, things that the risk management industry really needs to be aware of and involved in as early as possible. And all of the deals have some nexus back to that market. We kind of pride ourselves on, sometimes it's not a completely obvious nexus, but that's part of us trying to get out ahead. Sometimes we get it right. Other times, there are definitely some companies in our portfolio where what was that deal about? But that's that's the nature of the early stage risk class, I guess.
Yeah. And Eugenio, Plug and Play's active investor in Insurtech. How do you draw those circles? Are there the similar circles to Dan and also to Greg, or do you define it in different ways? How do you think about what is Insurtech?
Yeah, I think Dan did a great job at defining it. I would say we go even a step further, and basically the way that we look at things is insurance touches everything. Every single business activity has a component that has to be addressed because there's risk to every single thing. And so we look at this in a way that how we can provide protection. And it doesn't mean that there has to be an insurance product attached to it or that you have to sell to insurance companies. But for instance, we can even qualify with Insurtech, a company that sells protection if you're purchasing a ticket to go to an event and it so happens to be an NBA game, but you couldn't see the star that you were looking forward to seeing at the game. And then you you get basically protection for missing out on that experience. We're playing with different ways into how we look at risk and how we look at protection so that we can cast the widest net possible to address entrepreneurs that are potentially changing how things are done within insurance.
Awesome. And one outcome for Insurtech startups is to sell to an incumbent. And so I'd love your perspectives on what incumbents care most about, and whether it's customers, capabilities, new technologies, something else. How do you think about what is most strategic to the incumbents, who may likely be the ultimate exit for some of these companies?
I'm happy to start there. I mean, I think the answer is it's literally all of those things, and I think it's going to differ by each carrier. But there are some fundamental challenges. I mean, if you think of the traditional carriers, there's channel conflict. They're relying on agents, and agents have their business. So by going direct, are you going around the agents? So there's challenges there. I think the more traditional carriers are definitely looking for ways to engage with millennials and younger consumers, and who want to be more mobile first and digitally native. So that's a challenge. How do you bridge that gap? We've seen some, we obviously saw Prudential make a big bold move acquiring Assurance, but others have started their own brands, like Toggle, with farmers. So there's sort of that fundamental challenge there. So we've seen a few acquisitions of kind of consumer direct or business direct platforms, but it's a challenge because you have that potential channel conflict. I think there's lots of demand among the large carriers for anything that'll help them run their business more efficiently, obviously, but that tends to not be acquisition oriented. I mean, I think all of these are sort of reasons why you see much more financing activity and much more minority investments because of some of these issues. I think where we see very clear M&A is actually among the service providers, the core processors, the policy admin platforms, agency management platforms, the guidewires of the world, and building around these platforms and adding more capabilities. That M&A is very clear. But when you get to the traditional carriers, it gets a lot tougher. I mean, I think you'll probably continue to see them make acquisitions that add new lines, or just start thinking about auto insurance in a world beyond auto. We've seen Allstate make some bold moves on that front to add additional products. So it's a bit challenging from the carrier perspective, but obviously on the technology side, data analytics, it's a lot clearer, the path that I think we'll see from an M&A front or perspective.
Dan, what are your thoughts on what strategics care most about, and
so I think that's definitely been our observation as well. As Greg, is the PE companies, the software platform companies are more acquisitive than the carriers, but carriers are, I can speak for American Family, that group has never been busier on the M&A front, looking at new opportunities. At the risk of being overly simplistic, Stu, when you ask about what do they care about most, it's the fundamental economic equation of the insurance industry. They're looking to grow premium, they're looking to reduce expenses, and manage the losses along the way. So there is something interesting that's happening now, and I'm not sure how it's going to resolve, or I'm not sure how it's going to play out. And it's highly relevant to a couple of the companies in our portfolio. But the IPOs of Lemonade and Root, there's this gap between the market perception of that innovation that's coming through those companies, and how it's being rewarded by the tech market and the public market, versus how insurance executives think about those businesses. I mean, the multiples, I see Greg nodding, so I'm not sure if the rest of you can see him here, but the multiples are probably 4 or 5 times higher, something like that. Correct me if I'm wrong here, Greg. For those carriers, where they're being traded now as a multiple of premium or run rate premium or whatever kind of top line metric you use, versus slower growth, but more stable insurance companies, and that just creates this kind of oddness. I've been thinking a lot about how to navigate it. where it seems clear to me that the public market or sort of public perception is rewarding these companies out of a call to more innovation, more a friendlier user experience from the legacy industry, and it feels like the legacy incumbents in that space would do well to pay more attention to that rather than laugh it off.
Right.
But practically speaking, it creates this tension where you have investors like myself investing in these new companies at a particular valuation expectation, and there's a mismatch with what legacy carriers would be willing to pay to acquire those businesses. I think as that resolves, though, you'll see a number of acquisitions because the idea of digital first or a digital vehicle to acquire the next generation of customers would be very valuable to the legacy carrier, and the capital base of a large carrier that has surplus to support the growth of one of these things would be extremely valuable to one of these insurtech startups. So this is the space that I'm watching, I think, most intently over the next few years, because I think it has the most significant consequences on long term.
Can I just ask a question just to follow up really quickly on that?
Yeah.
Is that because you think incumbents have not historically valued growth and so don't have experience valuing growth? I mean, Lemonade is obviously growing very, very fast. You can argue around the economics of a business, but it is growing very fast. And so is it that Insurtech incumbents don't have experience valuing these fast growing companies, and so they don't appreciate that growth? There is a premium multiple, but there's also premium growth.
Yeah, I think that the way in a long term. I mean, imagine you've been leading an insurance carrier at scale for 30 years.
Yeah.
You would view Lemonade or Root as not just fast, but fast and loose.
Yeah.
And that is the complete opposite of what you've been doing for the entirety of your career. And so you think about they don't talk about the growth rate; they talk about the loss ratios.
Yeah.
And I think they focus more on the current state of maturity rather than projecting these things out. And the way I think about it, and the way I advocate people to think about it is these are eighth graders who can dunk, right? And so they're not ready for the NBA yet,
Right.
but they sure are on a pretty good track, and I think we should pay close attention to it.
Yeah, if I could chime in, Stu, I mean, we've seen this sort of play out in everywhere everywhere in the market, not even just financial services, but, Square's a great parallel, even Tesla, all these companies, people laughed at them and said, what are they doing? They're living by a different sort of, they're not following the economic playbook. I mean, they're just going after growth. They're losing money. They'll never be profitable. And public market investors love growth. They're addicted to growth up to a point. And the question is, can these companies, when I say these companies, meaning, Root and Lemonade, can they backfill? We know they can grow. They can throw a lot of money at growing, but can they backfill? Do the loss rates start to come in? Does the CAC start to look good? Can they backfill? And if they can backfill while they continue to grow, then they're going to continue to be rewarded with an outsized valuation. And that becomes a strategic weapon. Then they've got a currency and they can continue to sort of backfill and reach this escape velocity. I'd argue Tesla's probably there, Square's there, but there's lots of situations where companies haven't reached that sort of escape velocity. I mean, we saw it on some of the early alternative lenders that went public, and you can look at where they're now. They just weren't able to kind of reach that. The realities of financial services caught up to them. And that's the other thing. The second any of these companies have a hiccup related to losses or balance sheet issues, they go from being viewed as tech companies to financial services companies. And the valuation goes from multiple of revenue or gross written premium to book value. So it's a fine line they've got to straddle. And these public companies will be under a lot of pressure to keep that multiple, and it's not easy. But if they can do it, then they kind of transcend, and they have the potential to have bigger market caps than the incumbents. So that's the dynamic I see playing out here, and there's lots of parallels to other areas of the market.
Yeah, and given what Dan said about incumbents' historical aversion to paying up for growth, what role might the newly public Lemonade and Roots of the world play with respect to early stage exits, M&A, and the potential for some of these smaller companies today?
I mean, I'll just chime in quickly. I don't want to give others a chance to speak. I mean, it obviously creates a valuation bogey out there in the market. I mean, that's the bogey. When investment banking 101, you're looking at precedent transactions and public company comparables. And now that you've got those visible bogeys out there, everyone's going to use them from a benchmarking perspective. And are we growing faster? Are we growing slower? What do our loss rates look like relative to the public companies? Because so they definitely set sort of a tone, whether you like it or not. They do set a tone out there by which other companies are going to judge themselves. Simple as that.
I think Greg made a good point. When you saw Hippo's announcement of their round and then later saw what Lemonade IPO'd at, you probably would have seen Hippo getting a much higher valuation. I do think that with this companies, what we'll see is that in order for them to keep up with their growth, the way that Dan mentioned it, is that they're going to start increasing their pace in M&A to keep up with this sort of inorganic growth that will enable them to stay at a higher multiple of revenue. Otherwise, you have companies, the Geicos of the world, that don't trade at 10 times revenue. Otherwise, they would be trillion-dollar companies. And so we're definitely going to see more M&A.
Got it. And going back to the strategic conversation, the question from the audience that a lot of the focus in Insurtech is on the promise of efficiency gains. And question is, do big insurance companies look at this as profit that falls to the bottom line, or is it an opportunity to be more competitive when it comes to premiums and pricings? Any thought with respect to that?
Can you say more about that, Stu? It would look at what as the
the question is around like the efficiency gains that Insurtech can bring. Like, let's say it's claims efficiency. Do big insurance companies tend to think of this as an opportunity for pure profit, for margin expansion, or as an opportunity to be more competitive when it comes to premiums? So if they're able to save costs, does it translate into lower premiums for consumers?
Yeah, I mean, I guess the way that I've experienced it is it feels like there's a sort of machine learning war that's happening, almost like historically you hear about the kind of war for talent, and you don't really know where the battlefield is or who you're fighting against or and what other people are doing. But it definitely feels like there's a there's a need to outrun your competitors, but you don't really know what it is that they're doing just yet. And so you're seeing across the board large carriers are staffing up data science teams. They're investing in a lot of the point solutions from the startup market that can make their operations more efficient. Whether they return that as premium reductions or whether they take that as profitability remains to be seen, because I think a lot of these partnerships are still scaling.
Yeah.
Sorry, Greg.
I'll just say quickly, I mean, I think it's got to be both. I mean, it's going to depend on the line, competitive pressures and other things, but it's definitely both. I mean, there's clearly a focus on efficiency for profit's sake, but look, it's a very competitive market with new entrants, and what are the new entrants doing? They think they have an advantage on both fronts. They think they can price lower and be more efficient with a streamlined operation. So the traditional carriers are gonna face pressures on both fronts. I think it's pretty clear.
It'll probably happen in a number of books of businesses that have been unprofitable for a number of years. Take, for instance, commercial auto. Basically, everyone's pulling out of that market. No one has been able to figure out how to properly underwrite semis and trucks. So you're going to start seeing a lot of innovation going into how can we address and change this in a way that is efficient from the top line and efficient from the bottom line. Otherwise, you're just trying to make do with the float. And when you have very low interest rates, it doesn't really work.
Yep. When you all look at the market, talk a lot about the explosion in activity from an M&A, a financing perspective. Where do you see undersolved problems, whether that's a consumer need that's Insurtech related or a value chain need that remains unsolved? But what are the biggest unsolved or undersolved problems? I'd love to hear all of your perspectives.
All right, I'll start. There's a bunch of them, but the one that's been on my mind is it seems like maybe 5 years ago, there was a lot of talk about the effect of autonomy on the auto insurance premium expectations within our lifetimes, within our careers, and maybe within the decade or something like this. And it's gone the opposite direction. It seems like the severity's gone up as the frequencies come down a bit. But I'm not seeing particularly robust investment into what the future of mobility looks like from the insurance company perspective, and how does the insurance industry stay plugged into the data that will be needed in order to succeed long term as vehicles become more instrumented and more autonomous. It feels like an area where people talked about it and not enough happened. At least not yet. So to me, it's kind of an unresolved strategic issue that we'd love to get more active in.
Do you think that's because there was a lot of, as you noted, interest and activity around mobility, this expectation that Progressive, as an example, would see its earnings, halved because of autonomous vehicles. Autonomous vehicles feel further away today than they did 5 years ago, and so incumbents are thinking that there are more pressing problems. But you're saying that this is really an area we should be focused on because at some point it's going to happen?
Yeah, it's one of those classic. I forget the exact Bill Gates quote here, but it's something like you always overestimate the effect of innovation in the short term and underestimate it in the long term. And we're in the middle now. We all know it's coming. We stopped paying attention to it because it went through this sort of Gartner trough of disillusionment around the timeline, but it's still coming. And I'm not sure that many insurance companies have done much more than kind of diversify their strategy away from private passenger auto to some degree. So I guess we'll have to see what happens here in the next decade or so.
What about Eugenio? What do you think are the biggest kind of undersolved or unsolved problems in insurance?
Yeah, I can't say that there's one in particular. I think that there's no shortage of issues to be solved in terms of distribution, underwriting, or claims, which is why investing in this segment of the market is so interesting. As long as you have insurance companies, which by nature provide a social good, helping basically those that had a rainy day to get back on their feet, and as an industry as a whole, you have an NPS score of 40% or lower with health insurance companies with an NPS of 19%, there is still plenty of issues that need to be addressed.
Right.
But to Dan's point, I don't think that it has to come from within the insurance companies itself. One of the most interesting cases within Insurtech, in my opinion, is what Comcast is doing, which is you look at a telco company that made a strategic investment in Hippo, recently acquired a company like Notion, and it's really getting into homeowners insurance, using their distribution to actually tap into those customers. Bundling, now they're offering and adding an IoT device like Notion, which is sort of a comparable to Ring. I wouldn't be surprised if those are the guys that are going to eventually push cyber into everyone, just because there's going to be much more people working from home, and then you're going to get potentially many more attacks on people working at their houses.
Awesome. How familiar are you all with decentralized finance? There's a question around DeFi and what potential regulatory hurdles do you think these companies are going to have to jump over or, run away from in the next 12 to 36 months. Any thoughts on DeFi when it comes to insurance?
It's, I mean, DeFi generally, I mean, I know of DeFi in sort of the crypto world, just the ability to take anything in the traditional financial services world and have it run by a decentralized computer program. So I haven't really thought about it applied to insurance much. I've thought about it more from the lending, savings. There's things out there for those of you who don't know, Compound and Maker, ways to interact in a decentralized way. I mean, there's even swaps and other things being done online. I think with smart contracts, there's probably a lot you could do on the episodic side of insurance or parametric. But I haven't spent a lot of time, I haven't seen a lot of companies. I mean, it's a massive gray area because it just by definition, nobody can regulate it. You can't stop a computer program on the internet. So it opens a whole huge can of worms that haven't even really thought about at this point.
Got it. Anyone else have a thought on DeFi?
Just, it's another one of those areas where we've spent time in the past. We had people write sort of thesis documents on how does it apply to insurance beyond the reinsurance market, and it hasn't materialized the way that we expected that it would, but it remains looming out there.
Got it. I guess in terms of how incumbents respond to this, the threat from emerging Insurtech players, some of which have now gone public, and this is a question from the audience, there seems to be a great dispersion in how active those responses are. Companies like AmFam, Munich Re, Mass Mutual seem to be quite active. Geico doesn't seem to be active at all. Why do you think that is?
Why certain carriers are more active than others from an investment perspective?
Yeah, investment, partnership, acquisition, etc.
I mean, I don't know. I mean, Dan, you probably have a better read, but there's always this sort of, not invented here aversion. I think of more of as a corporate culture issue. Also, I mean, Progressive and Geico have kind of been on the forefront. They've been innovators. They've been innovating. So they've been kind of leading the charge, where I think others have had to play catch up to some extent, but probably a little bit of corporate culture, I'd say plays in there.
Yeah, I don't have the inside view as to why they're doing it, so I can't really speak for them. But it is notable. I mean, in the question there's something like 40 plus carrier-oriented VC groups right now, and of all the large, maybe the top 20 carriers, that Geico and Progressive are notable ones that seem to be missing there. So I don't know. I mean, from just a pure humility perspective, Geico has the choice to invest in the startup market or send the money back to Warren Buffett, and I'm pretty sure I know what I would do in that case. But I don't know. Nobody tell them that we're out here doing that.
We'll edit this out of the recording.
Yeah.
In my view, well, Geico, Progressive, Munich Re, all of them are partners of Plug and Play. To Greg's point, it does have to do with culture. It also has to do with how the organization is set up. We work with different business units and different teams within all three of those organizations, and we have over 70 partners. Sometimes we work with the claims team, sometimes we work with the innovation team, sometimes we work with the ventures team. And it has to do a little bit of how your company is set up for addressing and working with startups in terms of the sourcing, in terms of the vetting, or even in the corp dev team. But it changes, it varies. Some carriers, some insurance companies are at an innovation stage where they come and want to work with, they come to what we call the petting zoo. They just basically come in and look at startups and don't really know how to engage with them. Whereas the more advanced folks, like the team that Dan leads, it's the venture arms that we work with, like AmFam Ventures, for instance. These guys really, really want to engage with the startups, really want to understand what's driving them. We have separate events that we do with them in terms of deep dives and looking into different areas where we want to do perhaps co-investments and eventually see what's moving the needle.
Yeah, the other thing is, I mean, you don't have to invest. Progressive and Geico are going to get the attention of startups, whether or not they have a checkbook. So, I mean, we often, as we're out talking to large kind of traditional financial institutions, we do often advise them, you should think about investing. It's a great way to get the seat at the table, start seeing business plans. You're in the flow of innovation. But large organizations like that, people are knocking on their door all day long anyway. So you don't necessarily have to invest. It's just comes down to, I think, a little bit of just choice and culture. And they're certainly seeing a lot, I'm sure.
Yep. We only have 5 minutes left, so maybe we could end with some predictions. I would love your thoughts on this. What would surprise you most about the Insurtech market in 2021? Maybe we could start with Dan.
What would surprise me most?
What would surprise you most?
It would surprise me if we don't get another carrier IPO in 2021.
Who's that going to be?
I don't know. Let's find out. I'd love to say Clear Cover, but I think they're going to raise a Series B in the meantime. Maybe Hippo?
Maybe.
All right.
No comment. I can't comment on
What's-
I was going to say that, we have in our Q3 Insurtech Insights report, we've got a page with the sort of most well-funded Insurtech companies. I mean, that's your on deck circle. Literally 19 Insurtechs have raised more than $200 million. 8 have raised more than 500 million. 42 have raised more than 100. And so you can sort of see the on deck circle in that chart in our deck. So there's a bunch of names on there that would be going to eventually have some sort of exits, whether it's IPO. The other thing is we have SPACs. I don't know how closely everybody's been following the SPAC trend, but there's a ton of SPACs looking at fintech specifically. So we're going to have sort of a larger number of IPOs than we otherwise would have given this SPAC phenomenon. A lot of capital out there in the market that needs to get a deal done and has a burning fuse. And I'm sure there's lots of interesting candidates on the Insurtech side.
Yeah. Now, what would surprise you though?
I mean, to me, what would be surprising, kind of like what Dan said, if we don't see a continuation of this activity. There's so much capital flowing in, companies that have raised capital that are doing relatively well. To me, it's all laid out. The deck is stacked. We're going to eventually see more exits, whether it's M&A or SPACs or traditional IPOs. The deck is set here. I mean, to me, obviously the equity markets are a wild card. Ultimately, all this activity lags relative to what's happening in the equity markets. But I think I'd be shocked if we weren't talking about similar levels of activity a year from now. That would be the most surprising thing to me.
And then Eugenio, what would surprise you most?
Yeah, I would say I would be surprised if we don't see more M&A in the healthcare insurance sector, given everything that's been happening, especially after the CVS acquisition of Aetna. I'm sure more folks will start looking into vertical integration. We saw GoodRx, which recently IPO, and maybe perhaps after the TDoc merger with Livongo, you're probably going to see something around insurance or healthcare insurance in that space.
Yeah, I'd second that. I mean, we haven't really talked much about the healthcare insurance, but there's massive disruption, changing, going on, the delivery of care, Walmart getting into the business, and we're going to see, and then the consumerization is a big angle. I mean, I think there's humongous opportunity in healthcare, just given all the disruption and consumers bearing much more burden and their insurance paying for less and less. That's got massive implications as well.
Awesome. Thank you all for participating. Very much appreciate your time and perspectives. I want to thank all the attendees and all the registrants for also participating, asking a few questions. We'll share the recording of the webinar and the transcript once it's available. I'll make sure to share FT Partners Q3 Insurtech report with that. email, and look forward to future conversations with all of you, and have a great afternoon.
Thanks, Stu.
Thank you.
See you.